the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements for the day. Well, Singapore shares moved higher today as investors continue to digest earnings out of the country, including from the remainder of the trio of local banks who reported today, namely OCBC and UOB. So the Straits Times Index was up 0.76% at 4,260 points at about 11:40 a.m. Singapore time, and that is with a value turnover of 1.03 billion Sing dollars seen in the broader market. Now let's take you through the closing numbers. Well, the STI closed in the green as well, up 0.72% at 4,258 points. Now in terms of value turnover, we are looking at 2.14 billion Sing dollars. Gainers outnumbered losers 320 versus 201. Top advances for today, we've got DBS, Venture Corp and GMXUSD, and top decliners, we've got here UOB, Straits Trading and Jardine Cycle and Carriage. Now, in terms of companies to watch, no surprises there, all eyes on DBS because the share price of DBS soared to a record high in early trade after it posted marginally higher Q2 earnings before the market opened, nearing the 50 Sing dollar mark. Now, elsewhere, from how big name chip firms made big advances after US President Donald Trump said those investing in the US would be exempted from a threatened 100% tariff on semiconductors, to how the financial performance of Lyft and Uber, or what they can tell us about the state of the US economy. We've got more corporate and international headlines in focus. And joining me on the Thursday, as usual, is David Chow, Director at Azure Capital. David, how are you?
Hey, hi, Tian. You should have added joining you on this hot and scorching Thursday.
Hot and scorching indeed. I just hope, things are okay with markets. So let's start with global markets this time around. U.S. President Donald Trump said those investing in the U.S., they would be exempted from a threatened 100% tariff on semiconductors. One of the companies cited by Trump was Apple, though. So how have global investors reacted to the news thus far, particularly if we tie in with his wide-ranging tariffs that have come into effect?
Okay, I think while major tech firms like Apple, Nvidia, and Intel have pledged significant investments in the US to qualify for these exemptions, market reactions have been mixed, really, reflecting perhaps both optimism and a bit of skepticism. This optimism, I think, could be reflected in Apple share price, which of course surged following the announcement, and to a certain extent, this actually reflected investors' confidence in the company's ability to navigate the new tariff landscape. Similarly, Nvidia and Intel saw modest gains attributable to their existing U.S. manufacturing commitments. However, when I look over at the other side, shares of like AMD and TSMC experienced some declines, possibly due to concerns over their reliance on non-U.S. production facilities. So the effects really vary between companies to company. And most importantly, we are still awaiting the implementation details of the tariff exemptions, which remain unclear for now. So the lack of specifics regarding enforcement timeline and what are the criteria involved will somewhat add to the overall uncertainty.
Okay, and let's talk about Asian markets. I believe they rose in response to Trump's comments, and stock gains then were led by Taiwan's TSMC, which surged almost 5% in early trade because the island's National Development Council chief said the firm was in the clear. Now, we also saw gains earlier in Samsung and SK Hynix. So take us through the movements in Asia today. What stood out to you this time around?
Right, I think judging from the stock market reaction, both overnight in the US and of course the Asian markets today, markets is again hot and brushing this uncertainty off, at least for now. I guess TSMC to a certain extent, will be fine, given their, substantial manufacturing investments in the U.S. I think including, $165 billion commitment to build advanced chip facilities in Arizona. For Samsung, the company's inclusion in Apple's supply chain, supplying chips from its Texas plants is a blessing for now. And likewise for SK Hynix, after revealing plans to build an advanced chip packaging plant and AI R&D facility Diana. Even though this may not allow them to fully avoid tariff exemptions, I guess at the end of the day, these companies have somewhat navigated tariff challenges, through strategic investments in U.S. manufacturing. Will this pave the way for more companies to do that? Well, this could set a precedent in the coming days.
David, let's go back to the Singapore stock market as usual. How did the STI fare today, and any surprises when it comes down to the biggest movers? Hold on to your thoughts on banks. We'll talk about them in just a bit.
Okay, I think clearly we could see STI regain its upwards trajectory after a brief healthy correction, and I guess this is what most of us would like to see. This gives rooms for investors to come in to buy the dips, especially, from the retail investors. For us, we have heard from some reminders that the old clients who were seemingly, hibernating for some years, have started to contact them on, which, stocks they could possibly buy into. So, funny enough, when you start to see retail investors and perhaps, those old taxi uncles talking about investing in stocks and shares, this will probably send some signals that this could be the tail end of a rally. But I reckon, this is not the case for the current bull cycle this time around. And in terms of biggest movers, I see some healthy profit taking for now.
Okay, and let's zoom in on some of the companies to watch for today. DBS in focus. The local bank today announced that its net profit for the 3 months ended June rose 1% to 2.82 billion Sing dollars, and that is from 2.79 billion Sing dollars seen in the year-ago period. Net interest income also higher on strong deposit growth and balance sheet hedging. Fee income, treasury customer sales rose to their second highest quarterly levels. And as we shared earlier, the share price of DBS soared to a record high. So how would you read into movements relating to DBS today?
I guess DBS, share price could very well cross the $50 mark for this week. If there is nothing, bad happening on the external front. And, the STI Index, will certainly, should say a big thank you to DBS today for its positive closure, with DBS closing higher at, I think, 1.8%. While, UOB was down nearly, I think, 1.8% as well, and OCBC closed just, 0.3% higher. So before this latest set of results from DBS, I think certain voices in the street, including ourselves, have, stated that, DBS could possibly surprise on the upside. So with this set of delivery, DBS certainly has lots to cheer about. In terms of total income, I think the street has expected the total income to fall within a range of, I think, somewhere between 5.6 to 5.7 B, and DBS has exceeded that. And in fact, the total income for second Q even rose 5% year-on-year, driven by broad-based growth. And in terms of the bottom line, I think the street had, forecasted the net profit to fall between 2.6 to 2.7 B, and the actual income also came in, much higher than expected, coming in at 2.8. So this is already above the higher end of the anticipated range. And I see that the contributing factors to this come from better wealth management and trading income. So as such, we should expect 3Q to come off as slightly tapered down in terms of the wealth management income as well as the fee trading income, as we see some forms of tariffs coming into the market, and this may set the scene for just a bit of jittery coming into the market, which may affect sentiment for the capital market.
If you're just tuning in, when I'm in conversation with David Chow, Director at Azure Capital. A different picture when we set our sights on UOB instead. David, the lender there, announcing today that its Q2 net profit was at 1.34 billion Sing dollars, which is a 6% decline from that 1.43 billion Sing dollars seen in the year-ago period. Net interest income easing on lower margins. What was the key difference between the performance of DBS versus UOB and the underlying factors that gave rise to the showings?
So along with DBS, I believe some of the sell side analysts also spoke about the potential for UOB to surprise on the upside. Unfortunately, it didn't happen. So that is a clear reason, for some of the funds or even retail investors to sell down UOB today. And I think why is that? So I think for this set of results, I think it primarily arose due to differences in non-interest income and provisioning strategies between DBS and UOB. So when I look at the net interest income of UOB, it actually is on lower margins, and for the first half 2025 compared to the second half of last year, second half of 24, I think the net interest income actually declined 3%. 2% due to the net interest margin actually narrowing by about 6 basis points. And when I look at other interest income, this category declined 12% to 1 billion when compared to the second half of last year due to somewhat lower trading and liquidity management activities. So this is a direct contrast to DBS's robust trading income. And in terms of total allowance, UOB total allowance actually I think rose about 44% year on year to about 560 billion and increased by 7%. So this was attributable to higher specific allowance and preemptive general provisions just to ensure that they have enough coverage amid your macroeconomic uncertainties. So again, with these differences, this really sums up DBS ability to generate strong trading and wealth management fees, combined with potentially more favorable credit allowance movement for the quarter, which allowed it to somewhat surpass expectations, while UOB softer trading performance and higher provisions really led it to miss analyst forecasts.
I see. And finally, before I let you go, David, let's head over to the US. Lyft shares slid in late trading overnight because the ride-hailing company reported revenue that fell short of Wall Street's expectations. Now, the results landed just hours after Uber issued a better-than-expected forecast for the third quarter, though its rideshare unit recorded this $23.8 billion in bookings, slightly below expectations. Beyond the numbers, David, or with the numbers, in fact, what do the results of the two players suggest about the health of the U.S. economy and, in particular, discretionary spending in light of that weak labor data we saw last week?
We could probably go all day, dissecting the numbers and the relevance of all these numbers. But to keep it short, I could see that, for Lyft revenue miss, it really reflects ongoing challenges in scaling and expanding, especially outside the U.S. I think it raises big flags somewhat about consumer demand and competition pressure in a somewhat cooling economy. So meanwhile, Uber's stronger guidance actually suggests that, the market leader is benefiting from scale and diversification, including the likes of Uber Eats and Freight. So it really helped to cushion any softness in ride-hailing. And, I will have to say that there could be also a softness in discretionary mobility spending, and with Uber's booking miss and Lyft revenue shortfall suggests that consumers may be pulling back slightly on non-essential spending, like ride-hailing. So I think this will tie in with the weaker non-farm payroll data last week, which shows slowing job growth, and of course some will interpret it as a sign that the labour market is losing some momentum, and and this could further dampen consumer confidence.
I suppose we have more to watch when the weekly jobless claims numbers come in. Thanks so much for the insights today, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us today.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.